Hello and welcome. You're watching the Global Reset here on CNBC TV 18 Prime with me, Prashant Nair. Well, before our special guest who will join us in a bit from now, as always, let me quickly run you through what's the news updates and the developments which took place over the last sort of 12, 14 hours or so. Now, America's top trade negotiator, Brendan Lynch, has arrived in India to hold negotiations for the first time since Trump administration imposed 50% tariffs. This comes as U.S. Commerce Secretary Howard Lutnick criticized India for not opening up its farm products market to the U.S. Trump's top trade advisor, Peter Navarro, of course, also maintains his rhetoric on India. He reacted to the SCO summit in China, where Prime Minister Modi met Chinese President Xi Jinping and Russia's President Putin. Let's listen in.
Prime Minister Modi sent out a very conciliatory, nice, constructive tweet, whatever they do in India, and President Trump responded to that. We'll see that. This is how this works, but as a practical matter, we know that on the trade side, they have the highest tariffs of any major country. They have very high non-tariff barriers. We had to deal with that like we're dealing with every other country that does that. They use that money to buy Russian oil, and then the Russians use that to buy weapons, and then we as taxpayers have to pay more for the defense of Ukraine. And so how can that be? And watching Modi on a stage with China, which has been its longtime existential threat, and Putin, that was an interesting stretch.
Well, Peter Navarro there, of course, continuing his rhetoric. Now, the U.S. and China have reached what has been called a basic framework to switch the short video app TikTok to U.S.-controlled ownership. This will be confirmed in a call between President Donald Trump and his Chinese counterpart, Chinese President Xi Jinping, on Friday. Take a look at this report.
The United States and China have reached a framework agreement to switch TikTok to U.S.-controlled ownership. U.S. Treasury Secretary Scott Bessent spoke to reporters on Monday in Madrid, where negotiations with senior Chinese officials were taking place.
We have a framework for a TikTok deal. The two leaders, President Trump and Party Chair Xi, will speak on Friday to complete the deal.
Bessent said further details would be determined in Friday's call between Trump and Chinese President Xi Jinping.
We're not going to talk about the commercial terms of the deal. It's between two private parties, but the commercial terms have been agreed upon.
Bessent said a looming deadline that could have switched off the popular short video social media app in the U.S. pushed Chinese negotiators to reach an agreement. He also said the commercial terms of the deal will preserve aspects of TikTok that Chinese negotiators care about. Bessent added, quote, "We don't care about Chinese characteristics. We care about national security." China's top trade negotiator, Li Chengyang, had this to say.
The
U.S. side has generalized national security concerns and continuously expanded its sanctions list against Chinese entities. Its long-arm jurisdiction has reached deeper and further. This is a typical act of unilateral bullying, which violates international law and the basic norms of international relations. China firmly opposes this and raised serious concerns with the U.S. side during the talks.
Any agreement could require approval by Congress, which passed a law in 2024 requiring TikTok's Chinese owner, ByteDance, to sell the platform to an American company or face a ban. The U.S. has signaled fears that data from TikTok's 170 million American users could be accessed by the Chinese government. But Trump has sought a way of keeping the app open to Americans. He praised the TikTok deal on Monday. Earlier on Monday, a U.S. official with knowledge of the negotiations had said that the U.S. would press ahead with a ban on TikTok if China didn't drop its demands for reduced tariffs and technological restrictions as part of a deal.
Now, former U.S. Secretary Carlos Guterres, meanwhile, believes the deal will not be finalized in the next 2 weeks, but says the TikTok deal provides momentum to extend the deadline. Listen in.
China understands that rare earths are very important for the U.S., especially now when they have so much dominance. So they're leveraging that in the negotiations. They're pushing as hard as they can, and what they want is for loosened export controls. Now, I don't think a deal would be reached in the next couple of weeks, but TikTok has been the savior of these talks, and it could well be that an agreement on TikTok gives justification to both sides to extend the November 10 deadline out another 90 days. So that's why so much focus is TikTok. And right now, that seems to be the light at the end of the tunnel in terms of these talks right now in Madrid.
Well, shifting focus to the important Federal Reserve meet, the two-day meet begins today, and CNBC's Steve Leisman brings us details on what's at stake for Jerome Powell and the central bank in America.
There's a lot for those eyes to be looking at with a little Fed meeting mayhem. Just under 18 hours to go before the Fed begins its two-day meeting. Unclear how many voters will be there. Relative confidence, however, in how the voters will vote. Here's what's in play right now. The administration asked for an appeals court to overturn the Cook injunction against her firing by the president sometime by today, so we're watching the docket. The Senate's supposed to vote on the nomination of CEA Chair Stephen Myron, so we're watching the Senate. Cloture vote supposed to happen at 5:30, full vote at 8 o'clock. So there could be 10, could be 11, could be 12 voters at the Fed meeting tomorrow. We don't know. May not know till late tonight. Beyond personnel, the Fed has to deal with economic issues, inflation running above the 2% target, unemployment ticking up, and they have to find a compromise between hawks and doves, both worried about different sides of the mandate there. The futures market, not troubled by either the personnel or the economic issues. They overwhelmingly are priced for 3 cuts this year, 1 at each of the remaining 3 meetings. If Myron is approved, there will be considerable speculation about what you might call the Myron dot. President Trump was complaining that the funds rate, 300 basis points too high. No Fed official has the future dot anywhere near that. We'll see where Myron comes in. He remains, however, the chair of the President's Council of Economic Advisors on unpaid leave of absence. So it remains to be seen if he forecasts deep rate cuts. That could drive down the average rate that the market focuses on, but for the outlook for the Committee for Rates. Now, we could have dissents, Dom, in favor of a cut bigger than 25, and even a dissent for no cut at all.
Well, what we're going to do is take a quick commercial break here, but don't go anywhere. On the other side, we'll be joined by Christopher Wood, Global Head of Equity Strategy at Jefferies. Stay tuned, that special conversation coming right up. Hello and welcome to the CNBC TV 18 special. We are coming to you from the sidelines of the Jefferies 4th India Forum in Gurgaon, a marquee gathering where global investors, policymakers and India Inc. converge to debate opportunities and risks shaping the world's fastest growing major economy, that is India. Now, the next 3 days, September 16th, that is today to the 18th, the Jefferies Forum will host leading voices from across sectors, offering a pulse check on global markets and India's place in them. Joining me now is one of the most closely followed strategists on Wall Street. Christopher Wood is Global Head of Equity Strategy at Jefferies. Chris, it's always a pleasure speaking with you. Thank you very much and good to see you here in India once again.
Good to talk, Prashant.
Chris, I want to I start with the global usually, but I want to start with India first, since you're here in India. Now, the market at the headline level, Chris, has been sideways for about 14 months now, the Nifty, that is. We've seen a large amount of underperformance. So, for example, the MSCI Asia ex-Japan Index year-to-date is up 21%. India is up 1%, a 20 percentage point underperformance so far. What is your sense, Chris? Is that underperformance about to reverse, or is there more time correction on cards?
Well, first of all, yeah, that's a relative story. So that's more a question of it's less India doing badly than other markets doing well. And India's always had this premium valuation. So in the big picture, this is just a year of healthy consolidation in the Indian stock market, and what remains, in my view, the best structural growth story in global equities. So personally, I'm not surprised that we've had this year of consolidation, because we had high valuations, and the big negative for the market, at least one major negative, has been the huge supply, companies raising capital, but that makes sense from the corporate perspective because the valuations are high. And the big positive for the Indian stock market is the huge continuing mutual fund inflows have absorbed this supply. Now, if those domestic mutual fund flows did not exist, the Indian market may be down about 20-30%, and then that would have triggered big foreign buying. But because the domestic flows have been absorbing the supply, we've had this sideways trading pattern. But in the big picture, it's a healthy consolidation.
Is that likely to continue, though, Chris, for the rest of the year?
It's quite conceivable that it wouldn't be a surprise if we traded sideways for the rest of the year. Now, if we get a sudden resolution of this US-India trade thing, that will trigger a short-term rally. But the more important point in India is, do we get a pickup in nominal GDP growth next year? Based on the monetary easing we're seeing under the new RBI governor, and based on the various policies to trigger a boost in consumption demand initiated by the government this year. First of all was the income tax cuts, and then clearly I think more important is the rationalization and simplification of GST and the rate cuts, plus the monetary easing we're seeing, which has been considerable. All of this hopefully should lead to a pickup in nominal GDP growth next year, which in my view will lead to a stock market rally next year. But I am assuming a pickup in nominal GDP growth. If I'm wrong on that, then I'm too bullish. Nominal GDP growth is key because corporate earnings are reported in nominal terms, not real terms. Historically, India's been growing in a 10 to 12% nominal GDP range. This year, nominal growth's been, I believe, below 9%, and that reflects the relatively lackluster earnings outlook. But I am expecting a pickup in nominal GDP growth next year. That's the key driver.
Yeah. Sorry, so a nominal growth is 8.8%, quite low by what we've seen here in India.
Year on year.
Yes.
But actually, that was higher than what we and the market was expecting. So actually, the most recently reported GDP data came out stronger than I or the market was expecting.
Right. So just to, you're saying that if we get, you're saying it's entirely conceivable the market stays sideways for the rest of the year. But if we get a sudden resolution to the India-US trade issue, you may get a bit of a tactical rally. That's the call?
Definitely. And there's got to be a 50% possibility of that, simply because it's quite clear that these 50% tariffs are rather anomalous. It seems pretty clear they were triggered by the US president's personal pique, that he wasn't allowed to intervene in the India-Pakistan dispute. And it seems pretty clear from a US foreign policy standpoint, these 50% tariffs have needlessly antagonized India, and, it doesn't make sense from the US standpoint, from a diplomatic standpoint, to encourage an improvement in India relations with China. So for all these reasons, they're probably looking for my guess is the US is looking for some kind of deal. But if the US continues to insist that India opens up agriculture, or that India stops buying all Russian oil, then there will be no deal.
So how will this deal happen, Chris? I mean,
because it may not happen. And my view is very simple. In this Indian government and no Indian government is going to open up agriculture.
Yeah.
And my view is also very simple, that this Indian government is not going to be ordered around by the US about not buying Russian oil, most particularly when it's pretty clear to everyone that this oil is refined in India and then bought by the Europeans. The biggest risk to India, now if world oil prices dropped substantially and there's no longer a cost advantage buying Russian oil, then maybe India will stop buying Russian oil, but that's a different story. Indian government's not going to be ordered around by the US about Russian oil. I think that's been very clear ever since this whole conflict started.
Absolutely, and I think the position has been made very clear by the topmost functionaries in the government here. So then, when you say a sudden resolution, I mean, you're saying
but you can. Yeah, but there's other areas where you can where both sides can make compromises, which would allow for a face-saving deal. But obviously, it has to be on both sides. So I think there's a possibility of a deal, but I wouldn't be buying stocks and leverage on the basis of that.
Yeah.
The key reason to be adding to India the next few months is if you believe my story that nominal growth will pick up.
Yeah, that's the reason to buy Indian stocks and not not, of course, on the back of a deal. But a deal, you said there's a 50% chance of that happening, will result in a tactical rally here in India. Now, just one question more. Foreign investors, Chris.
But one other point that, yep.
Go on, please finish that.
No, I was just going to say the good part about this 50% tariffs, it's accelerated what the government was planning to do anyway, but it's definitely made them expedite the policy, and that was to simplify the GST structure and cut the rates. So in that sense, the 50% tariffs will turn out to be good news in the medium term.
Okay, got that. Now, FIIs, Chris, have sold about $28 billion of Indian stocks since the highs in September of 2024. You started by saying it's not so much about India, but it's about other markets doing well. What are you hearing from large global asset allocators about what they want to do? And India in positioning, FI positioning in India is at what, 15-year lows, 16-year lows. So when does that start to turn?
Well, that is actually the very interesting statistic. Because the reality is, in the last several years, the best two stock markets to own in the world have been the US market and India. So it is interesting that the FII positioning has become so low. I think there's a series of in some ways, coincidences. Last year, basically fourth quarter last year, there was big foreign selling of India to buy China. And that made sense because China basically, in my view, put in a long-term bottom. Fourth quarter last year at about 7-8 times earnings. So that was one definite big driver of India being sold to fund increased investments in China. And we've got to remember most of the foreign money in India is dedicated emerging market money. And then in more recent months, what's been going on is that people have been selling India to fund increased investments in Korea. Korea's had a huge move this year, and most foreign investors have missed it, so they've been playing catch-up. And they've also been having to buy back Taiwan because the AI trade's been running on Wall Street, and the Taiwan market is the same trade as the S&P 500, because the S&P 500 is dominated by big tech, and Taiwan's dominated by TSMC. So that's what's been going on. In terms of people selling India to fund Korea and Taiwan. If it wasn't for this Trump tariff issue, I think there would have been a chance that money would have started to enter India in the last 2 months. But because of the Trump tariff issue, the return of foreign money has been delayed. But going into next year, for people who buy my story that nominal growth is picking up, I would expect FIIs to turn net buyers by the end of this calendar year, even if this tariff issue is not resolved.
Okay. FIIs return net buyers by the end of the year, even if the tariff issue stays unresolved. I got that. That's a fair bit.
Because by the end of the year, we've had, the impact of this monetary easing should be starting to show up
Yeah.
in the real economy, the rate cuts, etc., the more greater ability of financial institutions to lend. Plus, we have the impact of the GST.
Got that. Let's just sort of tie in the India bit, and then I'll get to the global stuff, Chris. In your greed and fear portfolio, where does India stand? Are you overweight, underweight? And very briefly, if you can give us a flavor of what you've done lately.
No, I still have decent Indian weightings in all my various portfolios, but these are structural, longer-term portfolios, so I'm not running them too tactically. In my more tactical relative return portfolio, though, this year, I've only been very marginally overweight India, which for me is very underweight, because the only time I've really been big underweight in India in that relative portfolio in the last 20 years was back in about 2011-12 when we had some sovereign debt issues in India. And tactically right now, I would be looking to reduce China and add to India, given China's big outperformance of late.
Yeah, got that. All right, let's now get to some of the global stuff, Chris, right? And let's run through, start with the Fed. A 25 basis point cut this week. The bigger question, though, is this likely to be the start of a rate cutting cycle, Chris? Because earnings growth in the US remains strong, and at the same time, you're getting rate cuts. So it's like Goldilocks, in a way, once again. What is your sense, Chris?
Yeah, well, the rate cuts are clearly a signal that the Fed is prioritizing the labor market over inflation. Because the labor market, clearly the data has weakened in recent months. So it's getting harder to find a job, but it's not like there's massive evidence of people being laid off in America. So there's no great evidence we're about to have a US recession. But what's clear is the Fed has decided to prioritize the labor market over inflation. And I say that because the inflation is still significantly above the 2% target. So in this environment, clearly there's potential for more of a melt-up in the US equity market on the Fed easing. And you can make a perfectly respectable argument that the Fed shouldn't be easing yet. But the reality is the Fed is going to ease. Then you've got the political reality of the growing pressure from the Trump administration on the Fed to cut rates. That, in my view, is not about US economy or worries about the labor market. The Trump administration on the Fed to cut rates, in my view, is primarily driven by the desire to reduce the debt servicing cost of funding the federal government debt. Most of federal government debt is financed by short-term treasury bills. And so if federal funds rate is cut by 200 basis points, that will significantly reduce the debt servicing cost. That's what's driving this pressure on the Fed.
Yeah. So your call is, in this environment, right, wrong, we're not debating that. If the Fed were to embark on a rate cutting cycle, US equities can see a melt up from here. Any targets in the S&P in this environment, Chris?
No, but if no, I haven't got a target on the S&P, but in theory, they should just cut rates once and wait for the data. That's probably going to be the official Fed line. But if the market senses that it's the beginning of an easing cycle, then you do have that melt-up risk. My fundamental view, though, on the US stock market is that it's extremely overvalued. And my other fundamental view is that the AI capex boom, which is driving the market, will lead to a lot of misallocated capital. And I retain my base case, which I've had all year, that the US has peaked as a percentage of world market capitalization. But that's partly driven by the view that the dollar's entered a long-term downtrend. So far, I updated the numbers this week. The US is way below the 67th peak of world market cap, which it reached on December 24th last year.
Yeah, no, got that.
And the US stock market is much more high beta than most markets because the US stock market rally in recent months has not been driven by institutions. I think the institutions were surprised by the extent of the rally, given all the negative noise around tariffs, and it's definitely had a big retail component, this US market rally. The AI CapEx theme has been driving it, and in many ways, the AI CapEx theme creates an echo chamber because people will have been buying US stocks because AI large language models will have been telling them to buy AI CapEx stocks.
Yeah, got that. The dollar index, Chris, is down 10% on a year-to-date basis. You think it's got a lot more downside?
Short term, who knows? But in the medium term, my base case is the dollar's entered a long-term downtrend.
Okay.
That's a key part of my call that the US has peaked, made an all-time peak as a percentage of world market cap. And it also should be a following win for the emerging market equity asset class. But for now, it's a big positive for what the US, the Americans call the international asset class. And the international asset class is the world ex-US. And I showed a chart in my presentation at this conference this week, which shows that the world ex-US has broken out of a trading range in place since 2009. So that chart for now is confirming my base case that the US has peaked as a percentage of world market cap, even though the US stock market is trading at a record high.
Okay, world markets, ex-US, have broken out of a downward kind of trending phase.
Of a trading range they've been in since 2009.
Got it.
Part of that is outperforming. So it's not just emerging markets outperforming. A big part of that is Europe outperforming and also Japan.
Yeah, got that. Now, let's a few more things, Chris, here. You know, lots of interest with regards to what's happening in gold, Chris. Gold was at $1,000 in 2008. It took 12 years for gold to double to $2,000 in 2020. It's taken just 5 years for it to double again. I mean, not yet, but $3,700. So very close now. What's the view here, Chris?
Well, no, I remain constructively bullish on gold. Actually, I set a target of $3,600 an ounce for gold back in 2002. It's finally reached that target. Frankly, it should have reached that target 10 years ago, given all the crazy things that have been going on with G7 monetary policy. So at least we're now reaching more for sensible levels in gold. The short-term issue for me was gold going to break 3,500. So now we've broken 3,500. So it's beginning to look like gold's entered a new trading range.
Okay.
But I remain bullish, structurally bullish on gold. But the really exciting story right now is the gold mining stocks, because the gold mining stocks have been underperforming bullion in this bull market that began in 22. I mean, the real gold rally accelerated following the freezing of the Russian foreign exchange reserves in early 22, driven by central bank buying. Since then, gold mining stocks have been underperforming gold. Historically, gold mining stocks outperform gold in a bull market. And what's happened in the last couple of months, gold mining stocks have started to rally strongly because they are making a lot of money right now because they're in the perfect situation. Gold price is going up and the oil price is low, and their major input cost is energy, and the gold mining companies are not hedging their gold production anymore. So unless there's some operational issue in a mine, gold mining companies are printing money.
Yeah.
So that actually is the best sector to be investing in globally.
Any targets on Bitcoin, Chris?
Yeah, so on this, so basically gold and Bitcoin are the two key plays on long-term dollar debasement. And in my global equity portfolio, I have 10% in gold mining stocks and 6% in Bitcoin. So Bitcoin of late has been consolidating, but to me, this is a healthy consolidation, and the next big move in Bitcoin is up. So I want to own both gold and Bitcoin because there's a demographic issue here. The millennials may not buy gold, but they'll be buying Bitcoin. But if you said to me you can only own gold or Bitcoin, I'll own gold simply because history's on its side.
Okay, that's an interesting point. So bullish on both Bitcoin and gold, but you're saying near-term gold may have entered a bit of a trading range, although you're structurally bullish and you continue to own both.
And I'm saying Then I'm saying gold was in this trading range,
Yes.
consolidating between 3,000 and 3,500.
Yes.
In the last 2 weeks, we've broken above 3,500. So the key question now is that gold into the new is gold trend, going to break out significantly higher? That's the key issue right now.
Okay.
And that's why it's interesting that in recent weeks, the gold mining stocks have gone vertical. Now, the other interesting point about the gold mining stocks, when I last checked, there was net outflows out of gold mining stock ETFs year to date.
Yeah, yeah. Chris, just two more points. I'm running out of time. One, of course, is let's just come to President Trump now. In terms of these global conflicts, I know when we spoke, and this was before the inauguration, you said he's very keen and that he's going to end wars. And so far, the Russia-Ukraine war, no end in sight. Any thoughts there? Or?
That's absolutely the case. Yeah. So on that particular point, there was big expectations, including from me, that we may have got resolution on Ukraine with Donald Trump returning to the White House, which would have been a negative for gold, by the way, because the biggest risk to gold tactically is all these sanctions on Russia are removed as a result of a deal. Now, the problem for Donald Trump is he didn't end the war quickly, because to end the war, he had to basically cut off funding to Ukraine, which would then have created incentive for the Ukrainians to focus on trying to do a deal with Russia. But he didn't cut off the funding Ukraine. He listened to the neocon parts of his government. And so the problem for Donald Trump right now is what he called Biden's war has now also become his war. And it's very hard to do a deal on the Ukraine-Russian situation, which you can portray as a victory for the West, because the reality on the ground, so far as one can tell, is that Russia is prevailing in the war. So to do a deal, you have to significantly, you have to put the pressure on the Ukrainians to make a deal, and clearly that's not happened. So yeah, there's no sign of that being resolved at the moment.
Got that. Chris, last question. You did say that this AI capex theme in the US will lead to some misallocation in capital. A sharper question from my side, if it is are we starting to see a bubble building in AI stocks, large AI stocks in the US?
Oh, no, without a doubt, because, no, I think that's definitely the case, because the retail's driving this in the US. So back in January, we had the AI stocks sell off on the DeepSeek moment on China, because the Chinese came out with this open source large language model DeepSeek. It was very inexpensive. And the AI stocks corrected because the message of DeepSeek was that these large language models could become commodities. But since then, and I think that was a very valid message, but since then, we've had the mindset of the mentality of the stock market has changed. The US stock market is greeting AI capex announcements as positive in terms of endorsing the growth story. The 4 hyperscalers have guided for $350 billion of capex this year. These are enormous numbers. You've got a large capex on AI also being announced by many other companies. You've got a data center boom. And if it's indeed true that these large language models are commodities, and if it's indeed true, which is what I've been told by people who know a lot more about AI than I do, that you'll never reach so-called AGI by large language models, then a lot of money is going to be wasted. So my own personal opinion is the Chinese approach to AI makes more sense than the US approach. The Chinese approach is to use this open source DeepSeek as a resource to come up with cheap, viable use cases for the AI technology. This is, to me, a very practical approach, whereas the US approach is for each company in its own vertical to be spending all this money to come up with a definitive AI model. Meanwhile, the large hyperscalers are in the process of going from asset-light businesses to asset-heavy businesses, so they're going to generate significantly less free cash flow, and they're moving out of their individual moats to converge on the AI area. So they're doing that for both positive and negative reasons. The positive reason is AI is the next big growth story. The negative reason is the AI is the source of disruptive threat to their business models, so the move's partly defensive. So my view is you want to continue to own the AI picks and shovels, the companies like Nvidia and TSMC, who are benefiting from the CapEx spending. I don't want to own the companies investing all this money because I've got no idea who, if any of them, are going to successfully monetize this investment. However, if I'm wrong on this and they successfully monetize their AI CapEx, then there's a risk that I'm wrong on the view that the US has peaked as a percentage of world market cap.
And we should know soon enough, right? Or maybe not. Who knows? Who knows if we're at the moment of...
Maybe not, but if you wanted a symptom of a bubble, you could see the market reaction to the Oracle announcement last week of a pickup of orders.
Yeah.
A lot of pickup of that orders was driven by OpenAI. And right now, according to its own announcements, OpenAI is still burning a lot of cash.
Yeah. Chris, a pretty exhaustive conversation. Thank you very much for joining us. I had a bunch more, but we're out of time. Good luck with the conference. Good luck, of course. And I think your investors there, et cetera, would love to hear from you. But thank you very much for joining us here on CNBC TV 18. Thanks indeed.
Thank you, Prashant.
Thank you. Well, I hope that was an interesting and insightful conversation. It always is with Chris. It's a wrap here on this edition of the CNBC TV 18 special. More comes up after a quick break.